Good morning, everyone. If you're able to see my screen, I'm going to give you some overview of how you can look at the stocks and options information on Thinkorswim. I'm using TD Ameritrade brokerage platform, which is Thinkorswim platform, and I strongly recommend that compared to other brokerages. Uh, I'm logged into the system. So as soon as you log in, you come into the main screen, which says monitor. We will hover over to the trade functionality of the Thinkorswim system. If you are able to see on my screen, the top portion of this screen, it gives you some idea about the stock ticker, what you are searching here. So I am putting in Tesla and I enter. You will see the underlying equity or stock information is displayed there. So it will give you the last traded price of the stock as of the last trading day. It will tell you whether it was up or down and with what percentage. It will give you the bid and ask information for that stock as of the last trading day, and it will also give you some other details like what was the last price traded, what was the bid and ask, which was the latest trading session, what was the size, which is bid and ask sizes for that particular stock, what is the traded volume as of the last trading day, uh, at what price the stock opened, at what price the stock closed. It gives you the information of the highs and lows on that particular day. And then it also gives you the information about the PE, which is the price to earnings ratio. We believe that if the price to earnings ratio of a stock is higher compared to its peers within the same industry, it is expensive, which means that you need the price to go down to buy the stock if you are willing to, or if the price to earnings ratio is lower compared to the industry peers, which means that the stock is cheaper and you can think about investing into that if you like that. Then you have information about the dividends. I don't think Tesla pays any dividends, so dividend is zero. The frequency of dividend payment is zero. And then X dividend date is the date on which if you held the shares of that stock, then you are eligible to get dividend. It also gives you the information of the previous 52 weeks high and 52 weeks low, so you can gauge where the actual price of this stock is in the market. So it is closer to the 52 weeks high, which means it is an uptrend, but it is expensive. We ideally should buy this stock at a cheaper price. So you can compare the price and get some idea. And the total number of outstanding shares. It also gives you the information about beta, which is with respect to movement in the SPY or SPX in the market, which is our SPX is our mother index in the market, and SPY is the ETF that tracks the SPX index, right? So if SPY moves by 5 points, Tesla would move by 7.5 points, which it gives you some idea of how this particular stock is related with the index or the ETF, SPY or SPX, right? If it is greater than 1, which means that this is highly volatile and 50% more volatile than the SPY. If it is less than 1, and so say if it was 0.75, you would say it is 25% less volatile than SPY. So ideally, you should consider that in situation where the market is supposed to move up or move down, this stock is going to be 50% more volatile up and down during the trading. Now let's come back to the trade grid. It gives you some information when you type in the ticker here. It gives you the level 2 data, which basically is whatever the buyers and sellers, they are putting in orders in the market, including the retail players, including the banks, the institutions, how many buyers we have and how many sellers we have in the market, right? So it gives the price at which somebody is willing to buy one stock of Tesla. On the right side, you would see it is the seller information. It gives the price at which the seller is willing to sell one stock of Tesla. Now, ideally, these sizes are in hundreds, so it would be 100 shares and not one, but just to give you an example and make it easy, I gave you that example. So if you want to identify the stock is strong resistance, you will have many sellers in the ask size compared to the buyers, which means that the stock is approaching a resistance, and vice versa. If we have too many buyers compared to the sellers, if you look at the size, which means that there is a strong demand of buying the stock compared to sellers, right? So that is one idea you can get using this trade grid. And then we come to options. So what are options? Options are different securities than equities. They are usually categorized as derivatives. Options derive their value from the underlying stock price, but it is just not the stock price. There are a number of factors impacting the price of options. It includes the time to expiration. It includes the implied volatility, which is planned in the stock price movement. It also includes the actual stock price or the underlying price. So there are a few factors which determine how the price of the option will be calculated. Here you can see there is an option chain, and it reflects the information of calls on the left side and puts on the right side. You can see we have the bid and ask for each of the option strikes or contracts. Each of the contract for option is equivalent to 100 shares. On the right side, you have the information about puts, and it gives you the information of open interest, which means the total number of contracts which are open as of the last trading day, the volume of those contracts. Similarly, on the put side, you will have the open interest and the volume on the right side. You can see the implied volatility, which actually implies the approximate price movement of that underlying stock as of 13th of October. So by 13th of October, we are expecting Tesla to be $13 higher or 13 bucks lower than what the price is as of now. But because this is a earnings week, the price could be higher than that, but this is what is implied by the actual option contracts that is stand in the market as of that day, as of the last trading day, right? You can derive some of the basic information from this options chain. If you look at the volumes, so whatever option contract which has the highest volume, which means that the options are trading with a higher volume. If calls are trading with higher volume compared to puts, which means that the price is supposed to go up. And if puts have higher volumes for a particular strike compared to calls, which means that the price is supposed to go down. But ideally, this is from the eyes of the retail traders. We have market makers who are the institutions, big banks, hedge funds, mutual funds in the market who actually trade these option contracts, who sell these contracts to us. So if you look from their eyes, the situation is going to be vice versa. Just to give you a quick example, if you go to the today's option statistics, you have the calls and you have the puts information on the left and the right side. You need to look at the total number of calls traded at ask or above compared to the calls traded at bid or below. If the total number of calls traded at ask or above is significantly higher than those sold at bid or below, which means the total number of option contracts people are buying is very high compared to the market makers which are selling, it means that the price is supposed to go up. And vice versa, if you see the total number of puts traded at ask and above is lesser compared to which are sold by the market makers, again a bullish scenario. So you can get some idea of, as of this particular trading day, the number of contracts which are open. You can get an idea of if the price is going to go up or go down. And we also look at the call sizzle index and the put sizzle index information here. It tells us if the call sizzle index is higher, which means it is bullish. If the put sizzle index is higher, it means it is a bearish case for the stock. And in addition to that, you also have the option times and sales, because this is a I think markets are closed, you don't see anything, but the real-time option flow is reflected here in this section. So looking at the option chains, whenever we try to buy an option, it is, if we are buying it from the market maker, which is a buy a call, buy a put, buy a straddle, buy a strangle, you should always go out more than 30 days, because as I mentioned, if you buy an option which is closer to the expiry date, which is less than 7 days or 15 days, the value of that option will depreciate significantly because the time decay factor is there. So if you are willing to buy an option, even if it is for earnings or non-earnings, buy it 30 days out. So you are able to, you give it appropriate time for your strategy to play. Now, do not directly go blindly buy some option based on some recommendations. Do your own analysis, and that is what we'll be doing in the upcoming sessions. I will post a few videos on how to play options. Most of the times, if you buy an option, until unless the stock moves significantly, you are going to lose money. So ideally, we should be selling covered puts or covered calls depending on our strategy to make money, or we can do combination of calls and put spreads, which is like iron butterfly or diagonal butterfly or a calendar option spread that we can do to minimize our risk and to maximize our profits. So that's it in today's session. I will upload several other of these series, so I'm able to educate all of you and we can have a discussion, and then you can keep learning on trading styles. Thank you.